Tamara. I'm an associate analyst at Camissa, and I spend my time thinking really hard about how we can improve the cadence of idea generation on the global front. In the last year or so, I've spent a lot of time researching large language models like GPT-5 and integrating them into our workflows. And what I found is that by teaching systems to think like seasoned analysts, we're able to process large amounts of data really quickly and uncover insights that might otherwise be missed. And that really frees up time for these guys to do what's really important, deep, high conviction research. And so as we scale up, we think that really the possibilities are endless and we can process a lot more ideas and respond to market changes much faster. But Gavin, the only thing people are talking about more than AI at the moment is the gold price. What's Camissa's view on gold as a commodity?
Yeah, so we've delivered pretty good performance, as I showed in a moment ago, without a single gold share in the portfolios. So our view is very much that we think it's somewhat irresponsible to put investments in our clients' portfolios about which we have no insight. And I honestly think that calling the gold price, the level of the gold price, is something that is not achievable. I think there's nothing fundamental that informs whether the gold price today should be 3,000 or 4,000. And what there are, and we can all talk about and we can look at, is the drivers of the direction and the drivers of the marginal buying and selling. And I think it's very apparent that central banks and scared Chinese consumers who don't want to invest in property anymore are buying gold. And then a whole lot of people around the world are jumping on the bandwagon and bringing out stories. And I've heard stories that when inflation's high, you have gold. When inflation's low and interest rates are low, you have gold. There's stories for every environment about why gold price should go up. And I think that the most powerful thing in commodity investing or Bitcoin or gold or these things which have no floor is momentum. So I think momentum is one of those things that I was chatting to people in the office and their relatives are buying their kids gold, Krugerrands, and it's just like people who know nothing about investing are buying gold now and in large volumes, and it's basically this momentum train that's developing. And so I think that the potential for some of the geopolitical concerns which are driving some of this demand for gold to recede and for the world to become a little bit less of an uncertain place are reasonably high. If you look at what Trump and Xi Jinping are doing at the moment, and what's happening in Gaza, what's happening in Ukraine potentially, that gold price could come down to a level that there is no floor really below, sort of down to $1,000, I'd say. And in that environment, I think that the gold shares are potentially the most risky shares you could possibly have in your portfolio right now. The potential for them to move down 50, 60, 70, 80% is very high. We can't have that in our portfolio. So we don't have any gold in our portfolios.
What is your preferred resource exposure, Gavin?
So what we have done over the last 3-4 years is had a very high PGM exposure. And I talked a little bit earlier about sometimes it's very lonely and uncomfortable. It was very lonely and uncomfortable to have platinum group miners in our portfolios 2 years ago when they were very unpopular. And so our thesis there is that there are lots of fundamentals we can get our heads around, in particular the supply situation, in that it's very constrained who produces platinum metals, group metals, and where they sit. Most of them sit within a couple of 100 kilometers of here. And the fact that no one's investing for the future. So the supply is guaranteed to decline. And we think, in our controversial view, is that demand is relatively stable for the variety of industrial applications for PGM metals, which we know about, we all know about. But in addition, to the extent that the gold price goes up, our strong view has been that it will pull platinum up because there are many applications, in particular jewelry, but also as a precious metal, that the more the gold price heads above 4,000 or 3,000, the more you can substitute white gold applications in jewelry into platinum. And platinum looks like in the eye of the beholder. It sometimes looks better in some people's eyes or the same as white gold. and as I think it has, the gold price has dragged the platinum price up. So yeah, we've had PGMs, and then I'll end off quickly by saying we've also got big positions in Exxaro and Glencore, which both have coal mining businesses, but they also have other things. Exxaro has iron ore and now manganese, and then Glencore has a whole range of commodities and a trading business, including copper and zinc and other metals, as well as metallurgical coal.
Thanks, Gavin. You mentioned earlier that our yield instruments have been a large contributor to alpha over the past 18 months. Satish, what was the view that paid off for us, and how are we positioned now?
Sure, it's a good question, Amara. So just looking to answer that, I think we just have to rewind a little bit back to 18 months ago and where we were. And there was an extreme amount of pessimism being priced into the South African government bond yield curve. And to illustrate that, I think if we look at one bit of research that we looked at that time, it was a report from Moody's, and Moody's has an analytical tool that tries to encompass what the ratings, either upgrade or downgrade, is priced into those bond yields of around 13%. And what that came out with was that at 13% bond yields, our market was essentially pricing in two more downgrades to South Africa. Now remember, we're already sitting below investment grade. So for two further downgrades to materialize, it was extreme amount of pessimism that was priced in. So from that, it was very apparent that had two downgrades actually materialized from that point in, it was already priced into the market. So in theory, had that materialized, bond yields should not move much higher from that, as it's already priced in. So the asymmetry of returns that was there in the expected return figures was very apparent to us. And as Gavin pointed out earlier, our bond position was entirely in that long end area of the curve to take advantage of this extreme optimism. Now, you look at where we are today, the rating agencies across all three of them either have us on a stable outlook or positive outlook. So the optimism now has really come through, and pessimism, in a way, has gone out to some extent. But the positive that's coming through now in the markets is obviously now we've just recently been off the grey list, and the outlook on inflation with the SARB targeting a lower inflation point, that has really reduced the yield curve quite materially. And right now, our view, as pointed out earlier, is that we've shifted a lot of those long bond positions, in fact, all of them, into either the middle area of the curve or shorter end, and to try and realize a lot of those capital gains in the portfolios.
That sounds like we still have a preference for nominal govie bonds, but what about inflation linkers?
Yeah, that's correct, Amara. So we do have this preference for nominal bonds. And the reason why is that if we look at inflation-linked bonds, the key aspect of the inflation-linked asset class is that its explicit real rate of return is quite evident. And you can easily see that when you see where the levels are trading at. But similarly, on the nominal bond side, there's an implicit real rate of return. And at this point, we find that the yield real rate of return trading in the implicit nominal bond valuation is higher than what's being offered in the inflation-linked bond market. So we prefer nominal bonds over inflation-linked bonds at this stage, given this higher real rate return that's being priced into the nominal bonds at this point.
I see, but then what about corporate credit? That doesn't really seem to feature in the portfolios either.
Yeah, the corporate market, especially on the bank names in particular and some of the other corporate names, in my view, and I think it's probably the most expensive yield asset class right now, or within yield assets. And the reason being it's purely supply and demand. The credit market is not large. And the influx of inflows coming through from income funds, the latest ASISA data shows that that asset or that category of funds has continued to grow. And when you look at a market that's just about R1 trillion in size, and half of that made up from banks and SOEs, there's a very limited amount of corporate credit available. And the inflows coming in have just driven the spreads on these instruments quite low. And to illustrate how low they've actually become, if we compare bank credit to government credit, and you're actually finding that bank credit now are offering lower spreads than government issued comparable instruments. So what that means is that investors are requiring a higher level of compensation for holding bank debt, for government debt, than actual corporate debt, where the risk is somewhat greater. And the interesting thing is that banks, in fact, own about 20% of government debt. So if you're concerned about government debt, you should be concerned about corporate credit. So in our view, it's a very expensive area of the market right now, and our portfolios are very minimal exposed to corporate credit at this point.
Okay, thanks, Satish. At Doc, the equity team has also delivered an exceptional performance over the last 18 months. Can you give us a bird's eye view of our local positioning?
Yeah, thanks, Amara. It's been a very high return environment for us and for our clients on the SA equity side, and this has necessitated a lot of portfolio action. I think there's times in portfolio managers when you're managing portfolios where there's not a lot of action required in a fund, but that has not been the case the last 6 to 12 months. There's been a lot of action as we've massively recycled a lot of our winners into other parts of the portfolio. I mean, just by way of example, at the low points, Northam was 8% of our fund. It's more than doubled. Simplistically, if you double Northam in your portfolio and do nothing, it would go to 16%. It's now currently around 4%. It just gives you an indication of how much we've had to recycle, both into new and I think quite exciting SA ideas, as well as into global ideas, which Gavin will touch on, as well as some more fixed income exposure. So we've done this recycling exercise. It's, I think, also overall increased the diversification within the portfolios, and really trying to optimize the highest expected return ideas for our clients. So from a bird's eye view, the SA, I would say the SA portion of our assets, what we'd characterize as still quite low SA Inc. exposure. I think that reflects our quite negative view on the SA economy. If we look at it by sectors, I would say slightly overweight resources and energy, quite a big underweight in financials, and therefore quite a big overweight in industrials. If I run through some of those buckets, Gavin's touched on our resource exposure, our preference for PGMs over gold, and I think our preference in the diversified space for Glencore and Exxaro, so I won't touch on that. Within the industrials, where we, despite significant selling down, we still got a large position in Prosus, and that's one where, as we said, it was very lonely 2 or 3 years ago, actually, when Gavin alluded to the JP Morgan note that declared China uninvestable, and Prosus has tripled since then. So that hasn't aged well for them. But we were very overweight there. That's done nicely for our clients. We're still, I think, very excited about the prospects for their Chinese associate, which is Tencent, obviously, deeply embedded into the Chinese ecosystem, and I think still a lot of nascent verticals that they are busy growing in their business that can become meaningful businesses in the future. So I think excited about that. The new management team, we think, has breathed a lot of new life into capital allocation within the rump, or the rump portfolio of Prosus. So that's their investments in food delivery, payments, and classifieds. And so I think we can expect, better profitability and cash flows out of that portfolio. So still large in our portfolio is Prosus. Another one that's worked really nicely for us is MTN. Another case of feeling quite lonely a year ago when the Nigerian naira was blowing out and the MTN share price went down to around 60 Rand. And that's when we really saw this opportunity and took a meaningful stake in MTN. And that has now since also rallied strongly with the share price up more than 100% since then. So I think it's still a very compelling investment case with its embedded footprint of telco assets across a diverse range of African markets. It's got a huge scale advantage, a huge cost advantage, and can therefore, I think, really benefit from the big growth we expect to see in data. As population grows, as incomes grow, and as cell phone penetration continues to grow in Africa. So I think a really nice base of which to grow. And then on top of that, the cream you can put on is their very fast-growing fintech and mobile money platform that's scaling up in a number of African markets. So we think a lot of levers for growth at MTN going forward. So those are the larger cap industrial names. On the more mid-cap names, a feature of our portfolios where we can and have added a lot of value to clients is where we can take meaningful positions in mid-cap companies on your behalf. And ones that have, I think, continued to work for us over the years, and actually results were out this morning from Datatec, which is were very pleasing results. And that's just a global IT hardware and software provider, a very, very strong management team, and really benefiting from the trends we're seeing in a migration of corporate spend to cloud and a big spend in AI, which needs a lot of IT hardware for data centers and things. They're also shifting their business mix more to software and particularly on security. So a nicer, more annuity revenue stream, higher margin, higher return. So yeah, Datatech we think continues to be well positioned and deliver. And then lastly, just the other one to mention is Omnia, which is it's based in SA. It's done exceptionally well in its two verticals of agricultural fertilizers and chemical explosives, mining explosives, mining chemicals. It's continued to gain share against some of its competitors here, and it's taken this technology offshore. So it's been really ramping up its international exposure across both verticals, in mining into Canada, Indonesia, and Australia. And within the agricultural scene, it's got really unique technology in a product called Humate, which is a bioagri product. And they're working with partners to globalize that, which is also a very high margin and high growth business. So that's just a whistle stop of some of the names that we've positioned. And I think the portfolio, a diverse range of, we think, buckets of expected return.
You mentioned an underweight in financials, but banks look optically cheap. What's our view on the sector?
Yeah, it's a great question. We do actually have some banks in the portfolio. It's not particularly large. I think if we look at banks overall in South Africa, we would say they're probably fairly valued. Some where we think there is a reasonable amount of upside we're in. So the likes of FirstRand and Investec. So those are the two we would argue high quality names. I think if we look at banks almost over any market time period, they generally give you a market-like return. And we just think we've got much higher expected return ideas in other opportunities for clients. And as portfolio managers, we need to allocate capital to those. So yeah, that's really the reason it's a valuation call.
Okay, Doc, I've got one more question, and this is really for my PA. You've covered British American tobacco for over 2 decades, but we don't hold any. What's your view on the tobacco giant?
Yeah, I think it comes down also to a valuation argument. It's I would say where it's trading today, on our view, it's fairly valued. When it was much cheaper, it's also been a very strong performer over the last 12 months. When it was much cheaper in the sort of 500 to 600 rand a share range, we did own quite a bit in our portfolios, and as it ramped up, we sold down. I think the key reason is there's a lot of hype about how the company is migrating its portfolio away from its conventional cigarette portfolio into these next generation products. And you'll see IQOS, the heat not burn, which is the Philip Morris product, all the vapings, all the rage, and tobacco pouches. Those are the next generation products. As it stands today, the combustible portfolio still generates 95% of British American Tobacco's profits. And one thing we can say for certainty is at some point that's going to naught. You will get a lot of cash out of that as it slowly declines. But the question is, can they offset that with next generation products? And can they offset it at the same level of profitability as cigarettes? And those are the key dynamics we think about when we're looking at the investment case. I think we capture a fair amount of an outlook for British American Tobacco. We would say at this level, 10, 11 times price earnings ratio, 5-6% yield. I'd say given on the balance of probabilities, that's fair.
Okay, so better hold off. Global has also been a large contributor to outperformance. Gavin, can you walk us through the global process and maybe an overview of our holdings?
Yeah, so as I said earlier, equities for us are indistinguishable whether they're listed overseas or locally. So it's not a different asset class, it's the same asset class. And therefore, our research team looks at the research in a completely the same way. So the big challenge on the global side, which is also a great opportunity, is that there's just so many shares there. In South Africa, we've probably got 80 or so investable companies, and we're covering them at all times across our investment team. Whereas globally, we've got thousands of opportunities. So the first challenge globally is to whittle that thousands of shares down to a more manageable list that then we can go and do a deep dive and deep fundamental research into valuing them. So we have a wide variety of screening tools and screening processes that we run to get our list of, we call it our inventory list of stocks we're going to cover in a lot of detail. And that list is dynamic. It moves around a bit through time as share prices move out and as other companies become more attractive or some become less attractive. So it's once we've got our list and our stock coverage, we cover them in the exact same way with deep fundamental research as we do our local equities.
Then, Gavin, we deliberately don't hold any Mag 7 names. What's your view?
Yeah, so it's not deliberately that we don't hold them because they're Mag 7. We deliberately don't hold them because they look expensive to us. So we have, for the last little while, had 2 of them, which is Microsoft and Amazon, and a little while back we had Apple. But at the moment, we think with NVIDIA at $5 trillion in market cap, that's an enormous amount of future profitability that they need to earn. I think that I'm not going to go through each one, but each one I think has potential areas where their margins will come under pressure and competitors will come in and erode some of the profit pool that they're earning now. It's incontrovertible that they've got incredible business models now and incredible financial positions, and they're spending a huge amount on AI. It's not necessarily sure that their cash flows in 10, 15 years' time will be as large as they are now. So I think it's on valuation grounds and the amount of good news that's priced into those shares. Having said that, we are positioned in a number of other opportunities in the rest of the world where we see where valuations on our side prices are much lower and the potential is very high. So a company like Siemens, which is a multinational company listed in Germany, has a very large digital software type business, which is to do with software that goes into factory automation. And if that was listed in the US, I'd have no doubt that its PE would be double where it is today. And it's a high quality global business that is very undervalued. So we'd much rather be positioned in stocks that are very underappreciated and perhaps even in similar industries.
Thanks, Gavin. After a good run, advisors are asking what happens when the music stops? Satish, has our hedging strategy changed at all now that equity markets are at all-time highs?
Yeah, I think, I mean, to answer that question, I think our equity hedging strategy has always been a dynamic one. And we've used a combination of short futures positions, we've used put options, and at times when we felt certain stocks shouldn't be hedged, we've held long single stock futures against the options. And right now, I think if you think about hedged equity, it's essentially insurance. And there's two aspects to it. What are you insured for and at what level? And the second is the price of that insurance. And incredibly, just the way the market dynamics work is that as markets move higher, the input into valuing your options becomes lower and your option prices becomes cheaper. So when markets are at all-time highs, your pricing of put options actually becomes cheaper at a time when you want that insurance the most. So in our portfolios, we've been increasing the hedge over the last few quarters. The balanced fund portfolio has about 20% of its equity hedged. And what that means is that as the markets move lower from current levels, that hedge automatically increases. So by example, if the market drops 5%, the hedged component increases from 5% to 12% hedged equity. So you automatically have this dynamic movement from equity into hedged equity as the market moves lower. And that, by way, reduces the drawdowns on the portfolio. So with a relatively higher hedge than in the past now in the balanced fund portfolios, we think that if the markets do move lower, and in your words, the music stops, there'll be much lower drawdown on the portfolio's equity than if we'd not had a hedge at all. So I think it's right now, being that the markets are at all-time highs and put options are very cheap, we've increased the hedge to factor that risk component into the portfolios.
I see. You know, Gavin, now that we've unpacked the recent outperformance, where to from here? How can advisors manage clients' near-term expectations?
Yeah, so I think the market has delivered an enormous amount of return over the last little while. So most people would have had clients who are pretty happy at the moment. And I think that the reality is that I think it's times like this that one needs to be talking seriously with your clients about the fact that the next year, 2 years, 3 years is definitely not, like factually, is not going to be the same. It's not going to be as good. So the outcome, the outlook from here is much more subdued. It doesn't necessarily need to be down at all, and that's not at all what I'm saying. I just think the return expectations should be calibrated lower, and I think people should be operating a little bit more of a defensive posture. So not necessarily dramatic, but I think as we are doing in our balanced fund, and that's why I think choosing one balanced fund or a couple of balanced fund managers and letting them do the job is important, and we do the asset allocation. We take a bit more of a defensive posture. I think it's a time to be fully invested for future opportunities. I think there are opportunities out there. So to be fully invested in a more defensively postured balanced fund is right now, and return expectations are lower.
At the same time, volatility can be really unsettling for clients who are averse to drawdowns. Gavin, to put yourself in an advisor's shoes, how would you reframe the conversation to ensure that clients stay invested, especially when riskless bond yields are so attractive?
Yeah, I think that throughout history, it's been proven that nobody really can time the market well. So I think what one needs to do through time, as I just said, is in times of high markets and potential for volatility, be a bit more defensive in your posture, and to the extent that there are any drawdowns or negative volatility, I think be prepared to be invested there at the bottom as well. And timing that, I think staying invested is important, and having a slightly more defensive posture, and then making it a more offensive posture when if and when markets are volatile to the downward. So yeah, I think to stay invested is pretty key. Investment markets deliver real returns throughout time, and timing the market is really not a fruitful exercise.
Right. So, how might these risk averse clients benefit from the stable fund?
Look, our stable fund, I think, is very dynamically managed, and it takes advantage of a wide variety of opportunities and investments that can give us real returns through time. But I think the key criterion for our stable fund, as I tried to allude to earlier, was that our number one objective is to not go down and to protect capital. So for us, the major risk we're protecting is downward movement. So to the extent that one has a conservative client that doesn't want to see the downward volatility, stable fund is a great option. It's delivered significant real returns over the 12 or 13 years that it's been in existence. And it's obsessive about downward movement, protecting against downward movement. So I think that's a good option.
Thanks, Gavin. I've got one more question, and this one's open to all of you. Camissa's senior team has spent over 2 decades navigating markets together, which is no easy feat. Throughout your tenure, what enduring features have remained constant, and what excites you most about the future of the business? Doc, maybe let's start with you.
Yeah, thanks, Amara. So I think for me, I came to Camissa 12 and a half years ago, as I said, from having spent 8 years in London. I worked at some of the investment banks there, covering the consumer staples sector. So I interacted with a lot of the fund managers in the US and Europe as part of my job. And the one thing that struck me coming to Camissa was just the depth of knowledge and the breadth of perspective that the team had. I was really, really impressed. Sort of came in a little cocky, a little young, a little sort of I came from overseas, and these guys and the team have deep market experience, and that's only grown actually, obviously, as I've been there over the years. So that was the first thing that really struck me, and you only really know that when you join somewhere. And the second was just the discipline with which there is a focus on really what a business is worth, the real intrinsic value of a business. And sure, you've got outcomes around that, but just the consistent reference to what is the fair value? What does this mean for your fair value? What does this mean for your upside scenario? What does this mean for your downside scenario? That's an everyday conversation at Camissa. And it really helps, I think, impart a lot of discipline. It takes the emotion out of things. And I think it's something that is only improved over time as part of the process, and certainly something we are inculcating into the youngsters as they come into the business.
Thanks, Sitish.
So I think for me, I've been with the business for about 18 years now, and being part of an investment team, there's many great things about this team. Cohesion within the team, the dynamics, the discussions are quite engaging, and the in-depth knowledge. But the one thing that stands out for me, I think, is the discipline to approach, and that being across the philosophy and processes that we deploy into the investment process. And I think it's been quite consistent, not just through time, but across asset class as well. So while on the equity side, we've got strong processes and philosophies, that same strong process and philosophies are filtering over into the yield asset space as well. So I think it's quite internally consistent and stable through time, this philosophy and process that we've had. And I think that's just going to bode well for the future. And I think in addition to the future and things that I'm excited about right now would be the talent and the ranks that are being building up in the investment team. And I think in years to come, those different thoughts, those different views, different skill sets is really going to strengthen this investment team further.
No pressure. Gavin?
Yeah, I think I'm going to stop talking because I've talked a lot. But I think the enduring thing for me that's, and I alluded to it earlier, that's very, very important is to, in an investment environment, investment professionals need to be humble and need to continuously recognize that they definitely don't have all the answers and that we need to be continuously questioning whether we're wrong. And I think that's been something that humility has been a key part of our investment team throughout our 21 years, 22 years together. The other thing is just the level of intellectual debates and the excitement that to coming into work each day and having such high caliber colleagues to talk to and talk with and debate all the problems we have and things we're trying to worry about is a real privilege. So I'll leave it there and hand over to if there are any questions in the audience. Some familiar faces who I know I've got a lot of questions normally. Percy.
How do you relate your risk of being your protector and your stable if you're going to draw income?
Yeah, I mean, so obviously Protector sits within the medium asset class, a medium risk bucket. So you know, up to 60% of we will be sitting in equities. So I think you do have to accept a little bit more volatility than you will in stable. Stable's got a dogged focus on no capital loss or very little capital loss, whereas Protector, we really try and minimize the capital loss over a 6-month rolling period. So I think the building blocks of the portfolios are fairly similar. What you will see in Protector is a slightly higher equity component, which will then also bring with it a little bit more volatility. So that's really the calibration you need to make.
It's a bit more of an offensive posture. Yeah.
60%, or can you reduce it depending on market?
No, that's the maximum. So it sits within a range of 50 to 60. Generally, yeah. So at the moment, we're at the lower end of that range.
Any further questions? Yeah.
Regarding MTN, that's had a tremendous run.
Yeah.
Is the price, is it factoring in the potential worst case scenario from like the US, the potential legal outcome of the case with MTN? Is that sort of priced in, would you say?
Yeah, I mean, I think the question is, there's US litigation against MTN. Is it priced into the share price? I think the answer is most definitely. There are a couple of cases in the US in class action suits that are up against, and the DOJ there has taken up. It has given us a great opportunity to get a bit more of MTN recently because the share price did react negatively straight after results to that. The detail of it when we talk through it with management is that the one case, for example, is in a couple of cases. One case is in Afghanistan, where MTN has an extremely small subsidiary in this country, which is at civil war. It's a tiny part of MTN, which has no financial consequence whether it was there or not. But what happened was there was a Taliban attack, and the cell phone networks went down just before the attack, and there's an accusation by the families of the soldiers that MTN was colluding with the Taliban. Now, I think that's the reality is it's probably very, very unlikely that was the case. Obviously, it's local management. It's not impossible. But it's likely that some form of compensation will be arrived at, and it will be, we think it'll be very manageable for MTN. I think that's more than in the price. And there are a couple of other cases, each one on its own merits. I think there's a case around the fact that MTN paid various Taliban sort of chieftains in various areas for access. And I think if you speak to anyone who worked in Afghanistan at the time, everyone did that because you had to move from one place to another. You had to pay a toll road, basically, a toll fee. And so I think that's pretty uncontroversial. And then there are one or two others. There's one, I think, in Iran. And there's a Turkcell case where Turkcell are disputing the awarding of the license for Iran's telco to MTN from way back in time. The reality is, although Iran is one of MTN's biggest markets and it's a great business, MTN gets no cash flows from it. We value it as zero in the investment case. If they eventually get some cash flows out of it, it would be upside. So I think those sorts of aspects are definitely things to worry about, and they're definitely negatives. They're not material. And I think they are very immaterial relative to the size of the potential from a country like Ghana and a country like Nigeria and other African growth stories where the populations are young and growing. Their incomes are growing, some of the fastest in the world. and they're still not 100% penetrated by in terms of cell phones. And within the cell phone base, they're not all using data and smartphones. So that growth roller coaster that's still coming is enormous in the years ahead, we think, and underappreciated still in the MTN share price.
Gary, what is the view of Premisa with a growing number of DFM funds that are coming about? Is there space at Premisa considering that, or are you going to just hold in on the specialty funds?
Yeah, so the question is, how do we respond to the emergence of DFMs and the various DFM funds? So I think we do what we do, and that's really across basically 4 risk buckets, from stable fund, medium equity, high equity, balanced funds, to pure equity. And in the pure equity space, we've got global and local. And then our equity alpha fund is a bit of global with mostly local. So to the extent that a DFM wants an SA equity fund, we will give them an SA equity fund. We have that. To an extent that a DFM wants an SA balanced fund, we've got an SA balanced fund. But we don't have other funds, and we're not going to be offering any other funds. So that to the extent that a DFM wants a bond fund or a yield income fund or something like that, we're not doing that. So it's either those risk buckets or pure equities or one of those multi-asset class funds. And we're very happy to work with the DFMs, and we are on some of those buy lists. I know Fund House, for example, has us as an SA equity key building block for them. There was a question back there, yeah.
Yeah, a question to you again. You mentioned, I think you used the word factoring in terms of the returns we see now and not being mirrored onto the certainly short to medium term. Where do you see pockets of value based on that, given continued geopolitical noise? I think we're also heading into that ANC since 2027, where we'll be electing new president. So taking that into consideration, there's quite a lot of noise actually. Where do you see pockets of value?
Yeah, so I think that, as I said, expected returns are much lower. So the markets are much higher. A lot of our great ideas have paid off. The pickings, the expected returns going forward are a lot lower. So I say that incontrovertibly. So I do think if one looks across our portfolio, there are areas of, I think, still quite high expected return, like, for example, Exxaro and Glencore on the mining side. The PGMs, although they've run hard, still think there's further upside. In the financials, we really like Quilter, which is a wealth management business, which has got nothing to do with South Africa, and is I think got huge tailwinds. It's listed here, but it's a UK business. That's that. And then, as we said, MTN, we've got famous brands, Omnia, Datatec, are all businesses that we think a PPC are undervalued. So there's a wide variety of them, very different industries. But talking about the noise, I think one of the things with noise and uncertainty that I think everyone should appreciate is that it comes with positives and negatives. It can resolve itself positively or negatively. So just like with our election a year ago, or a year and a half ago, where there was a lot of uncertainty and it resolved itself with the government of national unity, which was perceived as much more positively, certain things run very hard to the positive but what's seen as an uncertainty resolves itself positively. So I'd make the same point about things that haven't happened yet. Now, Ukraine might resolve itself positively. It might. It'll have big ramifications in the world. The Israel-Gaza situation looks like it's resolving itself somewhat positively now. It could have huge ramifications for the Middle East, and it could have huge positives for the world. China, US may reset their relationship and become much more harmonious. That's not necessarily our base case, but it could happen, will happen with all this uncertainty around, as well as, if not more high probability than things getting worse. So I think that when one's thinking about negativity and uncertainty, it's both ways. It's not just everything's going to get worse. In our local environment, I agree with you. The political situation next year in the local government elections is very fraught. A lot could happen. Looks like KZN is leaning a little bit more towards MK and the populists. That looks negative. In Gauteng and elsewhere, it looks like the DA and the more moderate centrist parties are going to perhaps get a lot of local government support. How that resolves itself, I don't know. And I think the important thing is for us is to think 5, 10, 15 years hence, and do we see South Africa as a winning economy in the world and growing really strongly? And the answer is no. And we see deep structural problems that we just don't see it resolving itself. So our portfolios are much more linked to offshore-related economies and companies that happen to be listed here that are not linked to South Africa so much. it doesn't mean that certain stocks don't get really inexpensive and the prospects are underappreciated. Like, for example, we have now the highest weighting in the clothing retailers that we've had for a very long time because they've really come down a lot. Things like Foschini have really come down a lot, Woolworths and others, and Truworths. And so I think when the price is right, we will invest in South Africa specific stocks, regardless of what the political environment is going to be. We don't know what the political environment, we can't predict it. And we're looking at valuation and what we think is the negative outlook, what's still inexpensive. And we do see a whole lot of them. Famous Brands would be another example of fast food restaurants, Steers and Debonair's and Mug and Bean, and that is a company that's a great high quality franchise company that's very inexpensive in our view. Anything else? Nothing? Yeah, there we go.
You kind of get the gold price, so you can see much bigger drops, and we've had phenomenal returns in the last 5 years or so.
Yeah, so I think on the gold price, as I tried to say a little bit earlier, I don't think if ever I have a distinct view, I would suggest ignore it completely. I have no insight into where the gold price is going to go and what that level should be. All I know is that let's a company like Harmony Gold or Anglo Gold or Gold Fields, to produce an ounce of gold, it costs them $1,500-ish. And so that could be a sort of a floor if it starts to go down. Whether it goes down from here or goes to 10,000, I have no idea. It could go higher. If things in the world get a lot more uncertain, it could go higher. It could go a lot lower. So I have no idea, and we've got nothing in our portfolios to reflect that real uncertainty. Yeah.
Do you put crypto in the same category as gold?
Yes. Yeah. So even worse. I think gold, at least you turn off the plugs and it's still there, and then it's got a long history. But I think maybe to interpret your question a little bit more subtly, as an investment, I would, yeah. But as a potential technology into the future, I think it has huge potential. So stable coins, I think, are something that is something to really pay attention to, and the potential for doing really frictionless instant payments via stable coins, I think there's huge potential. And I think what the Genius Act that's happened in the US is very positive for that. And I think we're going to see a whole lot of real applications for crypto being used in the payment rails and undercutting MasterCard and Visa. And so I think watch that space, but not as an investment. I think the investment case has a lot of merit if you're in a country that's failing. Like in Ukraine, I think it's a huge mechanism to get money in and out and remittances into a troubled war zone. But or for cyber crime or for criminals and to money launder, it's fantastic. But those are the big applications for major crypto, other than stable coins. Okay, yeah.
Could you expand a little bit on your scanning process for global stocks?
Yeah. Mara, do you want to give it a bit of a go, or should I not put you in the hot seat?
So I think historically it used to be really based on organic idea generation. So analysts would do deep reading across a wide variety of sectors and then hone down on stocks that they find interesting. And what we've been doing more recently is using tools like GPT-5 to build Python scripts that can screen across large amounts of data, give us some preliminary insights on each company that we can then read through and then narrow down that list. And then that feeds into, as Gavin mentioned, the inventory list, the stocks that we really, really pay attention to, that we would have models and forecasts for. And that's allowed a lot more rigor into the process.
So I think to add to that, the two major ways we do it is sort of the quantitative way of doing it, which is sort of what Amara is talking about. And then we've also got what we call a qualitative screening way of doing things. And what we try and do is try and identify from just observing the world what are big, longer-term secular trends. So, for example, our great example would be the aging of populations in the West and in China. And what are the companies and industries that will be positively affected by the world getting older, and what would be negatively affected? And those are, in essence, to put a metaphor out there, is tailwinds that will be benefiting certain sectors, certain companies for decades ahead, and it's pre-programmed. So that's been one that's caused us to pay a little bit more attention to pharmaceutical companies, medical device companies, hearing aids, a wide variety of things that old people need more, and to think about those industries being very much benefiting from those tailwinds. And there are many other of those themes that are qualitative that we'd hone in on, and that's uncovered a wide variety of ideas that then we'll look into the quantitative side to look for us, screen for us. I think we've kept a lot of your time. Thank you very much for coming today. I think we'll leave it there. Thank you.
Thanks.